Uh, Welcome back to Academic Market Insights. I'm Dr. Russell Rhodes from the Kelley School of Business, joined by Dr. Alpha, Dr. Larissa Adamiec. We're going to talk about another Greek letter today, not alpha, but delta. Delta is an option pricing factor, probably the most important option pricing factor, but there's a lot more to what we get when we run all the numbers on options and find that we have a delta that's going to give us an idea of a few things. I don't want to jump ahead and steal all of Dr. A's thunder. So with that, I'm going to turn things over to her and we're going to talk about all things delta. And I'm going to do this part. And if you like what we're doing, hit like, hit subscribe, all those fun things. If you have things you'd like us to talk about, please send us emails. We've gotten a couple of messages that we've created videos around. I think as we get toward the end of the semester, and I'm teaching derivatives right now, delta is going to be very timely. So I think some of my students will be using this to prepare for their final. So with that, I'm handing it over to Dr. A and all things delta.
And it's our number one fan, Carly. She's also very interested in delta. She's heard it mentioned many times. She's very aware that delta is also uniquely tied to volatility. It's, you don't necessarily think of it as something as a volatility thing, but it is to some extent a measure of volatility and really a measure of the likelihood that this option is going to finish in the money, which is very important if you are trading options. So having said that, let's jump right in. Hey. Okay. We'll start from the beginning. Okay, delta in options, as Dr. Rowe was commenting, delta is almost what we would consider the first Greek when we start to think about Greeks. And for those of you who joined us for our Gammon session, Gamma is our second. And we'll talk about this. You can calculate delta and gamma, and they are the first and second derivatives. And for those who are interested in the math behind it, if we think about delta, it's the rate of change of the option price relative to the underlying price. And when we think about that, we're really trying to measure how much option prices are going to change when there's a change in price in the underlying. And gamma then measures the rate of change of delta. Okay, so it then becomes the second derivative. And for those of you who have a little bit of a physics background, think about it as speed and acceleration. So gamma is also going to measure how fast that delta changes. So having that said all of that and keep in mind, let's get into some of the fundamentals of what is delta. So delta, again, really looks at whether or not the option's going to, well, finish in the money, but it measures the rate of change between the underlying equity or asset, whatever asset it is. It doesn't have to just be an equity, and how much the option itself is going to change. And I like these two slides, and I'm going to toggle a little bit because this is what the delta looks at the end of the life of an option. And it's so binary. It's either 0 or 1 because either it's converted and it became in the money and it's now stock, or it's not and it was worthless. And so obviously it has a 0 delta. Versus when we're looking at the life of an option, it's going to have a bit of a curvature. And again, measuring that curvature is where gamma comes in. And you can see in this little graph that it really is the slope of the tangent line, which is the first derivative. And I apologize for diving a little deeper into the math. That wasn't what I was necessarily intending to do, but that's the fundamental theory of what we're doing or why we're doing it. But now let's talk about a little bit of the fun stuff. Dr. Rowe,
No,
you
I'm going to make you go back for a second because one of the cool things that you can do when we're approaching option expiration is if you have a stock or an index that's trading very close to a strike price, the delta with very little time left expiration, let's just say you've got a stock at 50 and you got a 50 strike call. If the stock goes to like 50.05, all of a sudden the delta is going to go from something kind of close to 0 to 1. It's just flipping back and forth. You can just, especially for really volatile stocks, on the close on option expiration Fridays, you can just see it where you have the delta 1 and the delta 0, where the option that goes from in the money to out of the money, that figure is flipping back and forth when there's very, very little time left to expiration. And for those of us that don't have any hobbies other than the markets, that's always kind of a fun thing to watch happen late on a Friday afternoon.
well, and I do appreciate that you said, particularly for a volatile stock.
Mhm.
So again, when we're thinking about options in general, and we haven't done a pricing video, and we should definitely do a pricing video. What drives the price of options and what everybody has is a distinct opinion about the price of options is really that volatility. That's the driver for what dominates price. I've worked at firms that don't talk about options prices at all. They only speak about basically pricing in terms of volatility. So again, everything really comes back to volatility, which is another reason why looking at the VIX is so important because that's what drives market. Flat markets that don't have volatility, there's not a lot of interesting things happening. We have already a sense of whether or not the option is going to finish in the money or out of the money. We don't have movement. And that's what makes, as you said, for those of us who don't have other outside hobbies, this is what makes it so exciting. So watching some of these things happen. So yeah, I'm glad you brought that up. Okay, so we can think of delta and with three different definitions. Again, we've talked about the first derivative is the rate of change, which is all a derivative is. And then it's roughly the probability of finishing in the money. So if we have a delta that's at the money, that delta is going to, or an option that's at the money, pardon me, that delta is going to be 50 or 0.5. So the two conventions are to have it at 50 or 0.5. They are equivalent. And that is saying that there is a 50% chance of it finishing in the money or finishing out of the money. And we use that 50-50 because we assume that returns are going to be normally distributed. Okay, and we assume that random walk, which is why at any given point, the stock is going to go up either 50% of the time or down 50% of the time. And we can also create a hedge ratio with utilizing our delta. And some of the hedge ratios are pretty neat. So we can create delta neutral portfolios. I used to make my students create delta gamma neutral portfolios, which is kind of fun.
It's pretty
You really,
challenging.
well, it's
That's,
it's it's cumbersome. Let me
yeah.
put it that way, because what you end up with is a system of equations of three equations and three unknowns. And because you're calculating the weights of each of these products are these different things. And again, it's an algebraic puzzle, so to speak, but it's other than that, it's not too bad. But yeah, that was always one of my questions on the exam. They didn't like it. I don't think they liked me for that. Okay, so our deltas that are out of the money. So let's say we have a delta of 25 or 0.25. Okay, again, the two conventions. This would imply that we have a option that is out of the money, and it implies that there is a 25% chance that the option is going to finish in the money. It also says that if the underlying position rises by $1, that the option is going to increase by 25 cents and vice versa. So if the underlying decreases by $1, the option should lose a quarter. Okay. And then again, we consider this out of the money because the delta is less than 50 or 0.5. So out of the money options. Now, an in the money option. So let's say that we have a delta of 87. Okay, so this is greater than 50, so we already know that it's going to be in the money. And again, it's saying that there's an 87% chance that this option is going to finish in the money. Again, very similarly, if the underlying goes up by $1, this option is going to go up by 87 cents. And if the underlying goes down by $1, this will decrease by 87 cents. So now we can start to see that this option is it behaving very similarly to the underlying. There's not that much difference between $1 and 87 cents. So we are able to generate quite a bit, or the two products are going to be behaving quite a bit. And Dr. Rowe, I'm going to put you on the spot. So at a little company that I used to work for, when we did media things, one of the popular media statements that were made, particularly for retail traders, was beginning retail traders should only trade options that have high deltas. And I was wondering if you thought that was an accurate statement. Again, beginning retail traders. And the rationale behind it, and I apologize for,
Yes.
because I want to give
Yeah.
you as much background. The rationale behind it was that the option was trading is very similar to the underlying position, and retail traders had a better understanding of the retail or the underlying position than they did the actual option itself.
So you worked at a firm that was that focused on trading options.
Hmm.
I worked at an exchange where we taught things very differently, where we really were more focused on long-term, risk management uses of options. So we would always suggest a good first option trade is selling an out of the money call against stock you own as a covered call, or
Yep.
or a vertical spread. And the reason and the vertical spread, the logic behind the vertical spread is the same as what you are saying, because you can formulate these where they basically move about 1 for 1 up and down, kind of like a collared position. If you buy a call, if you buy a 35 call and you sell a 40 call, you're going to have a price for that. Let's say it's $2. So your break even would be around 37. Basically, stock, your upside is to 40, your losses are limited below 35. So that eliminates the impact of implied volatility and time decay on the position. I think the logic is the same as what you're saying, where you don't have one of the nice things about a deep in the money option. There's not a whole lot of time value.
Mm.
We don't know what if you had a premium on this option, with a delta of 87. Actually, I'm looking at a stock option, 20 cents. I'm looking at I just happen to have a quote screen up over here, about 20 cents of time value. So there's not a lot of time value as well. So I can understand the deep in the money option, and wanting to have a pretty high delta so that the new option traders are not surprised by the price action around the option. So again, let's say you've got an 87 delta option that has very little time value, and it's just about all intrinsic value. and you see a big change in implied volatility for the options on an individual stock, because it's usually across all the options at an expiration, that's not going to really hurt your position. You're
Right.
not going to buy a deep in the money call and then a big seller comes in and pushes implied vol lower, and all of a sudden you have a significant loss. You might lose a
Right.
nickel or so. Whereas if you're looking at an at the money option that's all time value, and implied volatility drops, and we're going to do we're going to do a video on this one as well. If implied volatility drops, you could be like, I just paid 50 cents for an option, nothing changed, and now it's trading at 40. What the heck?
Right.
And that's the kind of things that I think you guys wanted to avoid.
Well, and we also
Yeah.
had at the time a brokerage arm. So this was a lot of
Yeah.
this was geared towards those traders that were using our brokerage. So you're also somewhat to extent minimizing complaints from
Yeah.
retail traders. Also, another big aspect of it, and I found this as I got into the industry to be an interesting, you're also looking to protect your clients so that they don't have major losses. Because a client that loses money is actually not a good client because you want
Oh,
them
but
trading.
yeah.
Um, and if for some reason the client can't cover the loss, the brokerage firm is on the hook. So there, and again, that surprised me. And it makes sense. I just hadn't thought about it before this was brought to my attention. And so there is good reason to be very careful around new retail traders and say, okay, we're going to help you, and we want you to be successful. This is something that's a good for you, good for us. We want that success. We want a continued partnership and relationship with you. So good. I'm glad I asked then. Okay. I again, high in the money options. It's as you pointed out, and I queued this up very nicely. It's not a volatility trade. And that was just to your point of if this something happens in an implied volatility and there's a drop, you're not going to be losing quite a bit. Okay. It's also a directional trade. So again, this gets back to the idea of really understanding that underlying, and if you're purchasing a high in the money option or selling it, you have a very distinct opinion of whether or not the underlying is going to go up or down, especially if you're naked, right? Then it's a truly directional bet. I like your example with the verticals because that does limit that downside risk. Okay, this is always one of my favorite ones. Um, and just again, it's when you think about it, you're like, oh, this is great. Um, and say delta and leverage. And I think particularly for the undergraduate students, when I present this example, their eyes always get really big. So if you spend $100 on a stock or an underlying, the most you can lose is that $100. But if you're buying a call option on the same product and it only costs you $10, the most you can lose is at $10. So now let's say that the underlying goes up by 1% and you've purchased the underlying, you've had a 1% gain. Now, if the underlying goes up by $1 and the delta is 80, your position is now $10.80. So you've just achieved an 8% gain. Wahoo! And 8% sounds a lot more fun than 1%, especially if you're putting $100 down versus $10 down. So I think options, particularly when you're starting to really think about this, and this is where delta comes in play, is you have a better sense of what the movement's going to be. You're now limiting that downside, right? Because again, you lose $100 versus $10. But you're interesting when you start to think about the actual percentage. And when we think about returns, we think about that percentage as opposed to the principal that's applied, right? So rarely, and I think it's hard for students to wrap your brain around. We don't, I mean, you have, especially when you begin teaching, let's say a corporate finance class, you've got your principal times your time value of money. But eventually that principal drops and we don't really pay attention to that anymore because you can apply that time value of money to any amount of principal. And 8% is always more exciting than 1%. And if it's not to you, perhaps then finance and trading options is not for
Not,
you.
yeah.
Yeah, I used to work at a Catholic institution, and I would tease to my students, and I would say, if this doesn't excite you, the religious building is to the right, to the right. And there's lots of wonderful majors that you can major in, and that might be a better suit for you. So I always like that. Um,
One thing, just one thing with leverage,
mhm.
and I hate that I'm getting ready to give credit to Purdue, but not in a bad way. And and I'm pretty certain that it was a Purdue professor that would say this, but when I would do tours of the SIBO, somebody asked me, and this was the answer to why would anybody trade options when they can just trade the stock?
Right,
The initial thing is leverage, blah blah blah. And I got that question. This was one of the professors that said each of you has to ask a question of this guy, or you're all going to flunk, or something like that. One person asked me if I owned any dogs. It was a
oh,
question. I mean, when there's 25 of them, they can run out of things to ask. And I kind
right.
of, I could tell when that was the setup. Sometimes I'd go, all right, you guys are have to ask a question, all right, you can ask me anything, personal, etc. So so that they got that requirement. But so why would they do that? And I say leverage, and all these Purdue kids mumble under their breath. Their professor had drilled into their brains, whenever they hear the phrase leverage, they should think when it's really good, it's really good, and when it's really bad, it's really bad.
Yeah.
That's all. You could buy, if the stock goes down by 1%, you're going to lose 8% on your position. Just keep that in mind. So
Right.
today's not about leverage, but I want to give a shout out to the guys up the road, and also do point that out that it works in both directions.
It does work in both directions. And, I'm glad you brought that up because I'm just talking about the positive, all roses and sunshine right now. But you're absolutely right. The opposite is true as well. You could have an 8% loss compared to a 1% loss. And it's funny you should say that in my doctoral program, as you're familiar with, I very much focused on the carry trade and foreign exchange, but that was one of the expressions about the carry trade. When it's good, it's real good, but when it's bad, it's really, really bad.
Just got to figure
So,
out ahead of time when it's going to get bad. All right,
right.
back to Delta.
Sorry.
You and I can go on one of these driving transit tangents. Like,
So I think this is the last of the slides. Yep.
there we
So
go.
delta
Good.
neutral. This comes back to the idea that delta provides what's called a hedge ratio. Okay. And you can come up with then, with this hedge ratio, a relationship of how many option contracts you would need to essentially create a neutral portfolio against delta. And so let's say that we've got $100 we've sold 20 call options, which again is controlling 2,000 uh,
Something in
shares.
the way. Yeah.
Sorry,
Mm.
I'm stumbling over
No,
my one.
it happens to me. We know that. So
And
it's just
then
like, yeah, it's the right to buy 2,000 shares.
right to buy
So
2,000 shares. And if you want to be neutral against changes in the market, you could buy then 1,200 shares if the delta is 60. And that would give you a delta position of 1,200 because the 2,000 contracts and multiplied by the 0.6 is going to give you 1,200. So you would buy 1,200 shares because each share has a delta of 1 because the rate of change with itself will always be 1. And now you've created a portfolio of 2 legs of 1,200 shares and 20 short contracts, and you're essentially protected against major changes in the market. Now, this is where I have to slip in a little gamma here because um, I want to be very clear that delta changes due to gamma. That curvature, one of the first graphs that we saw, because of that curvature, we're in a situation where that delta can change, and that delta is going to change by a rate of gamma. So just because we put on this position doesn't mean that this is going to be static for the entire life of the contract. We need to be prepared for changes within the portfolio, which gets back to my sneaky question to students saying, let's create a delta gamma neutral portfolio so we can not only protect against delta, but we can also simultaneously protect against gamma.
We
And
all
that
want to
is,
offset our gamma risk.
we do,
Always. Yeah. We always want to offset our gamma risk because basically gamma risk is the risk of a large price move against you, period.
right?
That's really just what it comes down to. So whenever somebody asks me about the markets, I just say I'm always worried about my personal gamma. In a story. Easy enough.
I can
So
see
awesome
students
sauce.
like,
I think we've come up with about 5 topics today. I want to do how market makers trade. I want to do, and I know that we're still taping. It sounds like we're having our after discussion. I want to talk about how market makers trade with the delta neutral trades. But I think we definitely have to do your first option trade.
yeah. And I
Yes,
know
I
our
think that's
number
it.
one fan would love to see
I think
how
we're going to do our first option trade, especially because I like that we have slightly different opinions on it. So this will be fun. Oh yeah,
absolutely.
stay tuned. That's going to be our next one for sure. Up there. Would you like to take us out because people like you more, and I'm like the dark side and you're the bright side. Go ahead.
Except for it's pretty gloomy, I think, both in Chicago and Indianapolis right now.
Out.
It's dark. Well, with that, thank you so much, Dr. Rowe. This has been fun to discuss Delta. And thank you, everybody, for joining us. We thoroughly enjoy doing this. We thoroughly enjoy working with you. If you have any ideas, questions that you have, please let us know. We are very open to it. And we'd love it if you liked our video and if you subscribed. So thank you so much.